Hi, it's Maggie Roth here. Directional trading with options most mirrors trading with stock. When the price goes up, you buy a stock position, and then when it starts to go down, you sell it. You make money. The difference between trading stocks and trading options is you can also make money when the price is going down. How can you make money when the price is going down? Well, the answer is you buy a put when the price of the stock starts going down and then exit as the price starts going back up. It sounds pretty simple, and the mechanics of the trade are just that, simple. But the art of the trade is where you start seeing the extraordinary gains you want. That's what I'm sharing with you today. Some of the art of the trade for those extraordinary gains. Hey guys, if you like these short videos and they're helping you either to get better returns or they're increasing your knowledge base as you prepare and learn to trade, please like and subscribe to this channel below. Directional trading is your first step to becoming a great options trader. Once you master these basic skills, you'll find more complex trading is easier simply because you understand the forces at work. So let's harness those forces step by step. First, find stocks or tickers that are moving in a clear up and down pattern. I prefer smooth patterns without drama in the tickers I choose. There's a relationship between the price of the stock and the option cost. That relationship has to do with the volatility of the stock. The more unpredictable the price, the higher the volatility, and the harder it is to trade. However, if the volatility is too low, you won't see the gain percentages you want to see. I prefer directional trading with an implied volatility of between 27 to 50%. I tend to get my best and most consistent returns in this area. How do you find out what the implied volatility is for each ticker you're considering? Well, on most trading platforms, this is one of the criteria you can add to your option charts. After choosing the best tickers to watch, the next step is to identify the best entry points. This is where support and resistance come into consideration. When you buy a call, remember that you want the price to go up. So the best entry point is going to be when the price is at support area and about to go up. For a put trade, you want the price to go down. The best place to place that put trade is at resistance, so when the stock goes down, your option makes money. Next, you have to choose both the strike to trade and the expiration period to trade in. Let's start with the expiration period. Most of my directional trades last about a week, maybe 7 to 10 days max. With that in mind, I don't want to go too far into the future because the price of the option will be much, much higher, and controlling the risk out that far is a little harder, and you're forced to trade less contracts. You also don't want to trade in an expiration period that is too close because of time decay. The minimum I will consider for my expiration period is about 2 weeks in the future. I prefer to trade 20 to 30 days in the future. Less exposure of time decay, the option price is less, and I can trade more contracts and make more money there. We've chosen our ticker to trade. We now have the expiration period. Next is choosing the strike to trade. In option trading, there's a Greek factor called delta. And delta is, for every dollar the stock moves up or down, the delta is what the option price changes for that same movement. I like to trade my options at a delta of about 50, which is right at the money. If you trade a higher delta in the money, the price of the option is higher. And to control the risk, you have to trade less contracts. So how do I calculate and control my risk? Well, first you have to decide how much you're willing to risk on any one trade. Are you willing to bet heavy and risk 50% on your portfolio total? I'm not. I usually set my limit between 2 to 5% of my total portfolio. That's all I want to risk on any one trade. Let's say you have $25,000 in your portfolio, and you've decided to risk the 2 to 5%. That would mean you could only risk between $500 to $1,250 on any one trade. Sure, it would hurt to lose that money, but it isn't as bad as losing the thousands of dollars more by not controlling that risk. What you're risking is the cost of the premium you buy the option for. Here's an example of how I'd set up a trade using all the elements we've just been talking about. Let's say you have $25,000 in your trading account. To calculate the risk, it's $25,000 times 5%. That would equal $2,500. And you're going to buy this option right at the money or the Delta 50 area. It's going to cost you $5.75 per share. Now there are 100 shares in each contract. So that means each contract would cost $575. If you divide that $575 into the $2,500 of risk, you can trade 4 contracts. Now let's say the stock price moves $3 in your benefit, and that means you could then sell that same strike for $7.40, making your overall profit $660. Same scenario, but this time you decide to buy in the money at a higher delta, and I want to show you the difference. Same $2,500 of risk. You buy it at where I've got the arrow there, you pay $7.40 a share. That means $740 per contract divided into the $2,500 means you could only trade 3 contracts to maintain the same risk. Stock moves the same $3 to your benefit. You then sell the same strike for $8.60, but your overall profit is only $360. So you can see why I like to trade at the money. That's where I get the biggest bang for my buck. Well, guys, now you have a basic understanding of directional trading. I want you to try it out. And I'm going to suggest doing it in paper money for a while until you get the hang of it. Then go to real money. This is just a small sample of what you'll be learning at Investing Buddies. We have a lot of educational videos on our website. There's also a weekly webinar where I talk about what I see in the marketplace and the trades I'm considering or that I'm in. And to make the decision really easy for you to join, there's a free 2-week trial offer right now. Just join us and try us out, and I'll see you on next Thursday's webinar. Thanks.